Welcome back to It's Only Money with financial advisor Scott Brown with Edgewater Family Wealth. And EdgewaterFamilyWealth.com is the website. The phone number, 407-648-1881. Tammy is here as well. Good morning, gentlemen.
Good morning.
Good morning.
It is good to see you. We're doing this one remotely. Scott is currently on my Zoom camera right now. I'm assuming living his best life somewhere. Where are you at, Scott?
I am in the beautiful Marriott Courtyard in West Palm Beach off of the pristine highway known as I-95.
Ah, beautiful, beautiful time. You must have all of the points in the world. Are you out there for business or pleasure?
Pleasure. My daughter had spring break this week, and she decided for spring break she wanted to, on purpose, get in a boat, go 4 miles out into very rough seas, and jump in the water with bull sharks. So I joined her on that. She was fearless. I was quaking in my boots the whole time, watching these sharks swim under my fins. But interestingly enough, they were more interested in eating the fish they were being fed than eating us. So I was pleased by that.
Well, thank goodness. When you first said swimming with sharks, I was like, that's some kind of high-end business term. He's in there with the with the financial people really mixing it up. But no, actual sharks.
Actual sharks, which I think it may in many cases be safer than business sharks. They're a little more frightening at times.
Well, we are here to do the financial show, and business sharks do exist. Let's kick it off with Tammy's with running the numbers. I got to get a song or something for this. It was like running the numbers with Tammy. I don't know, but we'll figure it out from there.
You could record that.
That would be a good song, yeah.
That'd be a #1 hit. All right, so hey Tammy, let's kick it off with stocks. People are always interested in what the returns have been. They're more interested in what they will be, but we're not in the fortune telling business, so we can tell them what did happen. Yeah, if only. Yeah. But the S&P, where are we at for the year, Tammy, on the S&P 500?
So for the S&P 500, we're down 5.5 on the year. That is by Flex Friday, but the index is actually up 4.8 since the Russia-Ukraine war.
What? So since the war started, the market is up?
Yes.
Who would have predicted that? Ryan, would you have predicted that?
I would not. I was all doom and gloom end of the world. So the fact that anything happens is amazing to me and shows the resilience of humanity.
Yeah, well, and certainly the U.S. stock market. One of the things that I often say to people is, where else is the money going to go, right? People say, the market's going to fall. There's a war. Well, whenever there is turmoil in the world, the United States is still the best place to put your money. At least most folks around the world seem to think that. So money flows into our stock market a lot of times when there is turmoil. I'm not sure how much Russian oligarch money is amongst that, but let's hope not much. But the bottom line is the U.S. is still viewed as a safe haven when it comes to stocks in turmoil.
Now, I do follow a lot of people, especially since joining this show. And a lot of the big word I hear right now is the word recession, the R word. And there's a thing called an inverted yield curve. What is that? Should I be concerned? Because that's what they said. They're like, this thing happened. And whenever this happens, that's when a recession happens.
So, Tammy, let's talk about the inverted yield curve, which is a favorite amongst financial news networks and amongst the folks who like to talk about things like this. The pundits, if you will, the experts love an inverted yield curve because it gives them something to talk about. So, Tammy, real quick, explain to us using some examples what the inverted yield curve is.
So the yield curve, first to explain it, it is something that we look at for different time frames that tell us what is the risk-free return on the government treasury bonds. Now, those are instruments issued by the government, and they're supposed to last for certain years. So we look at the 2-year, 10-year, and then 30-year. Basically, it's just money you lend the government. They give you back an interest rate on it every year for certain periods of years. Now, usually when there is the market or when the government wants to stimulate the market, those numbers will be low, because they want the money to be invested in equities. They want more cash on the market. So you'd see the yield curve like very low. But as it progresses, and then as the Feds increase the interest rate, you'll see that yield going up and up and up. Right now, for instance, when we look at a 2-year bond or 2-year treasury bond at 2.5. That is up from last week where it was 2.2. And it goes on and on. Now, for 10-year, for example, meaning if you lend the government money for 10 years, they'll pay you back 2.7 right now versus last week, which was 2.4. Funny enough, just a year ago, the same instrument would have returned 1.6.
Right. So we're seeing with the Fed moving to bring the money supply down, if you will, and tame inflation, what they're doing is they're raising rates to make it more expensive to borrow. Is that a fair thing to say?
Exactly.
So let's talk about the inverted yield curve, because again, people who get paid to talk often do. And that's why you hear about this stuff on networks all the time. So let's talk about the inverted yield curve. Correct me if I'm wrong, but basically that means that sometimes at the long end of the bond market, meaning 10, 20, 30-year bonds, usually you get paid a higher rate of return than, say, loaning money for 2 or 3 years, right? But that is not the case right now in some instances. So give me an example of a short-term bond that is actually paying, a government bond that is actually paying more than a longer-term bond.
Well, right now we're looking at a 7-year here, which pays about 2.8, while the 30-year pays about 2.7.
So that's what we mean, or that's what folks mean by an inverted yield curve. Now, to Ryan's point, a lot of times when you hear that, the word recession or depression starts getting kicked around. People will say that, and typically when there's an inverted yield curve, that is followed by a recession. Now, there is some truth to the fact that when recessions do follow inverted yield curves, but there is no truth to the fact that that's always the case. So I think that, there is no absolute here. It is not always the case. We've had inverted yield curves before where a recession did not follow. I'm not saying one will or will not in this instance. My belief is, unemployment numbers are really good. We're seeing an increase in jobs for, I think, the 11th straight month of over 400,000. So what you attribute that to, I'm not quite sure. I'm sure coming out of COVID plays a big role in that. But Ryan, to your point, an inverted yield curve, as fun as it is to talk about, it is not always a precursor to a recession.
Oh. Well, there went my my only financial news or info that I really knew. I was like, this yield curve thing, got to watch out for it. Ryan, can you explain yield curve? No, I can't. I just know. Next thing, recession.
That's right. I just ruined your whole cocktail party bit.
Yes. Is there a way to prepare for a recession? Should I be doing something just in case? And is there a downside to preparing for one?
Well, as we've discussed many times, recessions, a little less so in terms of depressions, but inflation, stagflation, recession, these are all parts of capitalism. People get really, really worked up about these things, and they're always looking for a scapegoat, and politics plays a big role in that, because politicians, in lieu of doing something productive, like to find scapegoats. That's kind of their profession these days. Whose fault is it? It's their fault. They being whoever isn't them, right? So can you prepare for a recession? I think only in so much as you prepare for anything in life. If we talk about sound financial planning principles, and we say to ourselves at the beginning of every year, we'd like to save this much, we'd have to have this much in a savings account. And sometimes people say, well, Scott, I've got all this money in a savings account, whether that's 6 months or a year or whatever's worth of expenses. And they say, I don't like that because I'm not earning anything on it. It's just gathering dust, which is very true right now. But as I like to say, sometimes you win by not losing. And what I mean by that is when a recession comes, there are typically layoffs, unemployment tends to rise, people struggle to meet their bills, whatever. But people who plan for those things, those messy things that capitalism brings along, because it's not all peaches and cream. If you're planning for the best outcome every time, you are going to be sorely disappointed, and you're not going to be prepared for when bad times come. As I like to say, plan for the worst, hope for the best. And historically, U.S. capitalism, free market capitalism, I'm not convinced we have exactly that anymore, but whatever capitalism we have, it's still the most free market in the world, I would think. It's a messy, messy thing. And if you are only prepared for when it's not messy, you are going to be sorely disappointed, and you're going to find yourself unprepared.
That's true. That's exactly where I am right now with my very tiny business. Because the cost of everything's gone up. No, I wasn't ready for that. I didn't know. So now I've decided. I was like, I saw what Doritos did, and they made chips. They put less chips into a bag, and that's what I'm doing with my kettle corn right now. Instead of raising prices, I'm like, I'll just give them less, and I'm a smart businessman.
You are a capitalist, my friend. Well done. You and the Doritos people.
That's right. I'm telling you, Scott, one day, this kettle corn thing, you're going to see my empire, and I'm like, I got all my info from Scott Brown and preparing. And if you want to get your info as well, EdgewaterFamilyWealth.com is the website. That number again, 407-648-1881. We'll be right back with more It's Only Money. Welcome back to It's Only Money with financial advisor Scott Brown with Edgewater Family Wealth. EdgewaterFamilyWealth.com is that website. 407-648-1881. Tammy is here as well. And I'm just looking over my super stocks, Scott, my GameStop that I own. And all I do every day is read about how good of a decision I've made by doing this. All the info seems to go well for whatever's about to happen, and I'm going to make all of my money all of the time. And but you're telling me during the break that that I'm fooling myself with something called confirmation bias.
Yeah, confirmation bias is, there's a reason for it. It's prevalent in society. It's always been a thing. When you make a decision, when you've decided to do something, whatever that something is, buy a stock, vote for a politician, join a group, whatever it is, it is human nature to spend a bunch of an inordinate, easy for me to say, inordinate amount of time and energy backing that decision up, right? Trying to come up with reasons why your decision was good. If you bought a stock, if you bought GameStop, you're going to, and even though in the face of it going down from 300 to 200 to whatever, you're going to spend a lot of energy Googling, why should I hang on to GameStop, right? You're never going to Google, more often than not, why should I sell GameStop, or am I a bonehead for buying GameStop? Nobody's doing that, right? Because nobody wants to admit they've made a mistake. It is cultural. I don't even know. It might be worldwide, but certainly in America, people have a really hard time with saying, I was wrong. That was a mistake. And that's unfortunate because
that might as well be in our Constitution. Never say sorry.
Never say sorry. Never say I made a mistake, or never say, I didn't really think that through very well. That's not allowed anymore. People aren't allowed to misspeak. People aren't allowed to say dumb things. I've said many times, conversations become unhelpful if we're not allowed to say dumb things or do dumb things, right? If you do something dumb, admit it, right? And if you bought a stock that isn't working out, or you got caught up in the fever and you said, yeah, I need to buy GameStop and AMC or whatever because all my friends were doing it and we were talking about it and it was great and everybody's excited and we were doing shots that night, so we all bought GameStop.
Yeah.
And then when you sobered up and the light of day came and your stock was down 30 or 40%, 50%, and then you looked around and you said, you know what, that GameStop shop that used to be at the end of my street is no longer there. And weirdly enough, I think you can buy games online now. So maybe, just maybe, after the tequila fuzz went away, maybe this was a bad decision, but that's not what people do. What they do is they get aggressive. No, it's a good decision, and here's 7 reasons why. None of these reasons make any sense, but I made a decision. Therefore, by default, it was a good decision. I'm going to spend a lot of energy trying to reinforce that.
But I've put my money in. First of all, you think I just did this willy-nilly from an app where I just very quickly got in a moment and clicked on, okay, that's exactly what I did.
No, you did. You definitely did.
But the thing about it is like my money is there now, right? Like I've put the money, I've watched it go down. As you said it, like this does sound stupid. I watched it go from 300 down to like 140, I think is where it's at right now. But my money's there. I'm not taking it out now. Those are my soldiers in there doing work for me, and I've already paid the money, so I might as well wait for this thing to happen, which is going to come back. I can honestly say this with 100% confidence. I've never read an article saying that I'm an idiot for doing this. So
right, because you've never looked for that article. It's out there, I promise you.
But my money's there, Scott. I'm already in.
Yeah, they call that sunk cost. People get caught up in the sunk cost. It's like somebody who, battles are a good example, although, again, I hate war analogies, but since we've already started down that path, if you say, well, we've lost half our soldiers, and you say to yourself, but deep down inside, you can't win that battle, but you're like, I've already lost all these soldiers, so let's just go for it. It's just, that's what we call in the business sunk cost, and sunk cost causes people to continue. Enron's a great example. If you looked at the Enron debacle from many years ago, and the stock dropping and dropping and dropping and dropping, and large investment firms, large brokerage houses reconfirming solid buy, it's getting better and better every day. It went from 80 to 40. Oh, you got to get it now. And why? Because they're already invested in the idea that they told you it was a good buy, even though the evidence is pretty strong to the contrary. So sunk cost can be intellectual sunk cost, right? You've spent a lot of energy, a lot of time, you've thought about it, you read about it, you looked it up, and it still went down. And now you're like, hey, gee whiz, I haven't been to the movies in 6 years, and Netflix and Disney have these streaming things, and I don't really want to pay $15 for a Coke anymore, but I still think AMC is a great buy. Right. So these are the things that we do as human beings. The people who are successful, this goes back to what I've said for years. When people ask me, what is the number one attribute of a good investor? It's humility. Because good investors know when they've made a mistake or they've been over emotional, and they make changes based on better information, which is also not allowed in this country anymore, right? If you say something, you got to own it all the way to the death. You got to die on that hill. Even if you get better information that says, oh, the information I was using before seems a little flawed. Maybe I got caught up in the moment. Maybe I was angry. Maybe I was tired. They say that judges, when they sentence people, if you get a judge in the afternoon, you are statistically more likely to get a heavier, quicker sentence because the judge is tired, the judge is ready to go home, whatever the reasons are. And we think, oh, these things don't exist. These bias don't exist. Judges are judges, and judges are people. Mm-hmm. You're a people, right? People make you're a people, right? Ryan?
Yes, I am a people.
Okay, good.
I hope so.
I'm also a people person, so double people.
Yeah, double people. So people make decisions. They make good decisions and bad decisions. But even when they make a bad decision in this day and age, for whatever reason, we've retaught people to argue in the face of overwhelming evidence that they're wrong. No matter how clear it is that they're wrong, to them, to everyone around, people lately are married to whatever they already decided. And I don't think that's good for investing, and I don't think it's good for society.
It's definitely not. I mean, you can that the sunk cost thing, as I was sitting here thinking about, goes into so many things. People do this in interpersonal relationships with their husband or wife. They'll just stay in. They're like, I've gone this far. Aren't you really sad all the time? Yes, but I've already put in the years, And I actually did this with college a little bit, where I was like, I kind of knew by the time I was like finishing up, I was like, I'm not going to do anything with this degree. But I was like, I've put the time in. Let's go another 5 to 10 grand in debt and just finish this bad boy out. And still to this day, never used my degree. And I'm always like, that's sunk cost. We were just talking about that.
Yeah, and talking about relationships, I mean, that's a great example, and this isn't a therapy show, but relationships are a great one. People continue romantic or emotional relationships with folks that are mean to them, that are physically abusive, because they've got, I married this person 10 years ago. We've got this much invested in the relationship. We have a house together, and they can come up with 30 or 40 reasons why they shouldn't leave this horrible person. And that's true of investing. Again, if you told all your buddies one night, hey man, I'm buying this AMC, a great example is the crypto mob, as I like to call them. And to be clear, I'm not anti-crypto. I think there's going to be something to blockchain, Ethereum, Bitcoin, whatever it is. I don't think we quite know what that thing is yet, but I think it's going to be a thing. With that said, there's a group of people that if you say, wow, gee whiz, I don't think it's what? Then they get all angry and they all come together. Pitchforks come out, torches come out, and they want to chase you down the street because you're not buying the narrative, even though they can't counter the argument. They can't say, well, no, it's going to be this. They'll just say, it's great. Okay, can you elaborate? It's great. No, you said that already. What's great about it? How's it going to work?
Technology.
How is it a currency, et cetera, et cetera? I said it was great, and that's the end of it, right? So
Yeah, they're the vegans of finance.
They are how do you know somebody's got crypto? They'll tell you.
Yeah. I never had anybody get more mad at me than I was just slightly suggested that maybe NFTs aren't what it is right now, and this seems a little silly. And I almost got a bottle thrown at my face for that, for like a light suggestion that we just don't know yet.
Yeah,
That's can't. Forbidden.
It is. We can't have that kind of negative talk, Ryan. Stick to the narrative. It's like when you get in the elevator and you say hello to somebody and you say, hey, how's it going? And then they start telling you their whole life. No, I would just stick to the script, man. I just want you to say hello. That's it. I don't need more information. So these people want you to stick to the script. The script is I bought crypto. It's awesome. It's going to take over the world. I'm going to make $7 million. And that's the end of the story. Do not bring anything into the conversation that would lead one to believe that is not true.
Yeah, because they got a point, because if enough people talk, it's just this ethereal thing where it's literally one of them's named Ethereum, that if you talk bad about it, it will go down. And that's just a fact. And there's rug pullers. I'm all for like whatever it can be. I'm excited to see what it will be.
Sure.
But this version of like you could just go on your computer, make up your own coin, get some influencers to push it, and then just pull the rug on from everybody and walk away with $6 million. That shouldn't happen.
No, and I have had the good fortune or misfortune, depending on the day, to listen to some of the foremost experts in this area, and I can tell you they're not even sure what it is right now.
No. So if you want, good advice, the standard of advice, that's Edgewater Family Wealth with Scott Brown. That number, 407-648-1881. Hold on to your crypto. We'll be right back. Welcome back to It's Only Money with financial advisor Scott Brown with Edgewater Family Wealth. EdgewaterFamilyWealth.com is the website. And number 407-648-1881. And I'm here with Scott and Tammy. Man, your confirmation bias thing has just got me thinking during the break. And it's I don't know what the difference is between I'm just making a good decision and this is confirmation bias. If I'm not seeing it, how do I know?
Well, you need a devil's advocate, right? There was, if I understand the story of how that term came to be, I think a pope back in the 1500s, 1600s, they had a process for making saints, right? Someone would be brought up and they'd say this person should be a saint for these reasons. And then the pope would say, okay, yeah, they're a saint or they're not a saint. And that process became, and I don't remember the actual pope who did it, but they created a person whose job was to be the devil's advocate, to say maybe there's some things wrong with this person that would not allow them to be a saint, right? That's where that term came from. And we as investors need a devil's advocate, whether it's your advisor or your spouse or someone you respect. If you're making purchases of securities, you need somebody to be a little bit of a naysayer before you're allowed to push the button, right? And to that point, the statistic I read was since the 1600s, there's been like up until 1978, there were like 400 people sainted in the Catholic Church. But in 1978, Pope John Paul II, I believe, did away with the devil's advocate. Do you know how many saints there have been since 1978?
I'm going to imagine the number skyrocketed.
Over 400. So for hundreds of years, there were 400. And then in a couple of decades, there were 400. So everybody became a saint at that point. So again, we all need that devil's advocate to say, is putting all my money in Bitcoin or AMC or GameStop or Tesla or Microsoft for that matter, is that a good decision? And I think it is, but let me run this by somebody else or a professional, somebody that I respect, who I believe can give me another side. People hate the other side of the story, right? They don't want to hear it. They don't like having their narrative. You see this in politics all the time. If a friend of mine says, I believe this, that, or the other, and I say, well, explain that to me, they get instantly angry. I didn't say I didn't agree with them. I didn't say what they said is nonsense. All I said was explain it to me. And what you find with people, whether it's politics or stocks, is if you ask them to dig deeper into the conversation, the people who don't have the answers just get angry. They get loud and they get angry, right? It's the same with crypto. I've been doing this 35 years. I've listened to the foremost experts in this area. I still don't completely understand it. I understand the essence of it. I understand the theory. I understand why it could be something good. I understand blockchain to some degree. I understand all of that. But I still don't know exactly how this crypto thing is going to play out. And I'm comfortable that I don't understand it. And I'm comfortable with somebody coming up to me and saying, no, Scott, it's going to be this. I'm all ears. Tell me what it's going to be. But most people don't operate that way. Most people are like an inch deep in a 10-foot pool when it comes to intellectual effort on many very important topics like politics, like culture, like investing, like whatever it is. So if you find yourself getting angry at someone because they asked you to explain something, you need to look in the mirror and say, maybe I don't understand this as well as I should. And that's where a devil's advocate might come into play.
Well, I got to imagine, too, there's a point in time in history where, somebody was like, hey, I think the sun, we revolve around that and not the other way around. And that was not meant with, open arms, so to speak. It wasn't like.
No, people were killed for saying things like that.
Yeah, we hate changing our ideas. The fact that therapists aren't constantly attacked every single day as they're telling you what you're doing in your life is wrong is pretty good for humanity. But yeah, we do not like to have our views challenged by any means. There's something in us that gets angry, sometimes violently angry. So imagine with stocks and money and all that kind of stuff, it's something that you're so connected with, especially us as Americans. I mean, you getting told that something isn't the way you say it is, it's going to create a reaction.
Yeah, I mean, there's a Reinhold Niebuhr who was I guess for lack of a better word, a philosopher who was prominent during the FDR years. He's the one who came up with the Serenity Prayer. God grant me the ability to not try and change things I can't change and know the difference in that whole thing. That's how most people would know him. But he wrote a book called Moral Man, Immoral Society. And in that book, he talks about the fact that if you and I have a conversation about stocks or politics or whatever it is, it's just you and me. We're in a room, we're just talking, we're having a beer or whatever. We can find common ground even if we disagree, right? You can make a point and I can make a point, and you can say, well, I believe AMC is good and here's how it's going to come back and they're going to reinvent themselves and it's going to be an online thing and it's going to be like Netflix. And I can go, okay, I hadn't thought of that. That's interesting, but I think they're behind the curve. I don't think they're going to catch up to Netflix or Disney. We can have that conversation. What Niebuhr says, the problem becomes when a third person enters that conversation, because that third person is going to take your side or mine. And once that person takes your side or mine, let's say they take mine, I no longer care what you think, because now I have somebody confirming what I believe. He came in believing AMC is a joke. I thought AMC was a joke, and now we just spend our whole time beating up on you because you don't think AMC is a joke, right? So that dynamic, that human dynamic where we seek out groups of people who, political parties, whatever it is, I mean, that's the easy one, right? If somebody says something, yeah, I believe in that, you and I are buddies, right? If somebody else says something contrary to what you already think, your natural impulse is to not engage with that person, which is the worst possible thing you could do, both culturally as a society, and certainly a bad thing when it comes to investing. If you surround yourself with people who only agree with your investment philosophy, you are going to eventually drive off a cliff together.
Yeah, but in terms of a devil's advocate, I mean, obviously there's you, financial advisor Scott Brown, who can be that devil's advocate. But in a standard everyday life, I mean, who should it be? I mean, it's spouses, friends.
I think spouses can be good and friends can be good as long as they're people who are thoughtful, people who are well read on the topic, and people who maybe don't share your exact opinion. I mean, Ray Dalio is famous as a famous money manager. He's a thinker, in my opinion. He's a true intellectual. He's trying to figure out how to solve the world's biggest problems. And he says, seek out the person that you most respect that disagrees with your narrative. And if that, and a lot of times it is the spouse. A lot of times I'll have a husband and wife come in, a couple, comes in and he's more aggressive, which isn't uncommon for the man to be more aggressive and think he understands things better than the wife, and the wife will oftentimes say, let's take a step back. And sometimes it's the other way around. I'm not trying to pigeonhole one gender or another. What I'm saying is one person is typically more conservative, one person is typically more aggressive, and that's a good dynamic unless one of them dominates the conversation. So that's where I tend to come in and say, all right, let's mediate this thing a little bit. You think this, you think that. Here's kind of where I see it, and here's how I think we can make both things work. Men, not always, but on average, tend to be more aggressive and kind of overconfident in what they can do. I got buddies that I play golf with, and they could have a shot 250 yards over water. Now, they haven't hit a shot 250 yards in the air in 12 years because they're in their early 60s, but they're pretty sure this time they're going to hit that shot all the way over the water, put it on the green, and one putt for an eagle. That never, ever happens for them. But they are convinced, and this is an overconfidence thing. That's another thing we see is people become overconfident, right? They become overconfident. If you ask a room full of 100 people, and they've done studies on this, how many of you are above average drivers? How many do you think will say they are?
90%.
93%.
Wow, yeah.
Exact. Right. So it is, I don't know a lot, but it is statistically impossible for 93% of the drivers in that group to be above average. That is statistically impossible, but it's what we believe. We believe we're a little bit smarter, a little bit better looking, a little more athletic, yada, yada. We all believe that. And that can't be true, right? Some of us have to just be plain old boring average people, right? So when you think you're better at investing or gambling or designing societies, I'm going to tell you the odds are you're probably not.
I wonder though, that has to be something built into us as human beings just to continue forward in society, or just in life. Because when you're a caveman and you got your spear and you're looking at a woolly mammoth, you're like, I could take him, and some of you are going to be right, but one or two of you cavemen might not make it back, but you're coming back with the woolly mammoth. Now, everybody was confident in this, and I would say it helps move society forward. But when it comes to complicated financial decisions, I would say probably a bad thing.
Yeah, no, I think that's right. I think you did have to have a little bit of foolishness in your mind to want to pick up a spear and attack a woolly mammoth, but they did. Right. And maybe we're thankful that they did. But like you said, a few of them didn't come back.
Exactly.
The below average ones did not come back.
Right. But that caveman was rated himself above average. He was 93% of cavemen were like, yeah, I'm above average at taking down woolly mammoth.
Totally above average.
Well, if you want financial advice, not advice on how to take down woolly mammoths, I'm sure Scott does offer that service for an extra fee. But go to edgewaterfamilywealth.com, and the number to get a hold of Scott is 407-648-1881, and we'll be right back with more It's Only Money. Welcome back to It's Only Money with financial advisor Scott Brown. Tammy's here as well. They're with Edgewater Family Wealth, and edgewaterfamilywealth.com is the website to go to, or you can call them at 407-648-1881. I like my analogy of the caveman because I think it goes into finance, as well, because without risk, there's no reward. There's no such thing as risk-free when it comes to this world, right, Scott?
That is largely true. But one of the things we were talking about earlier, and let me, before I say what I'm about to say, the truth of the matter is, if you remove risk from anything in life, really, the rewards are minimal. If you say, well, if I don't leave my house and I grow my own food and I build a bunker and a moat with alligators in it, then I'm reducing the amount of risk in my life. But you're also just going to sit on the couch for the rest of your life. And the reward for doing that, in my opinion, would be minimal, right? Versus a person who takes risks in life and are idiots like me and swims with sharks in the middle of the ocean for no apparent reason. So, the rewards are many. My daughter and I got to spend a quality time together. She was not afraid. I was admittedly afraid, but we did it anyway. So without risk, the rewards are minimal. What we were talking about earlier is the risk-free rate of return. And what I mean by that is CFAs and smart people like Tammy. Tammy, how would you describe in money management, what do we use the risk-free rate of return for? What does it help us measure?
It mainly helps us understand the current climate when we invest. We look at something, as you mentioned, called risk-free, which is not risk-free, but we use the vehicle of government treasuries, because the risk of the US government going bankrupt is to a minimum, and we hope it stays like that. So that is usually our risk-free. And whatever you loan the government money, and then they'll give you back a rate, that rate is what we consider risk-free. For the time horizon that money is being loaned.
So like today, the 10-year was at 2.5, right? Is that correct? Or is that the 2-year? I don't remember.
The 10 years was about 2.8. Yes.
Yeah. So we're at 2.8 on the 10-year. So I think by most standards, when we do an equation and we try to, in our business and in your part of the business in particular, because you're the guy that crunches the numbers for us, you would say, all right, well, let's compare the return of this other investment to the risk-free. In other words, is it worth it? The risk-free rate of return on a 10-year, which is used in most algorithms, right? When we do the math on, we use that as the risk-free rate of return, right? So when you hear risk-free rate of return, most of the time that's the 10-year treasury somebody's referring to. So if it's 2.8, right, and we say, well, there's no risk in that relative to the world, then we certainly would want to earn 3 or 4 or 5 to take some risk. Otherwise, we would just use the risk-free rate of return. So people would say to me, Scott, well, how does the risk-free rate of return, having come up from, say, less than 2% not that long ago to 2.8, how does that change the dynamic when it comes to the stock market? How could that negatively impact the stock market? And I would say, before you answer, I would say that if someone's deciding putting their life savings or 100 grand of their life savings in a place, and they say, well, I can only get 1.5 in the risk-free thing versus the opportunity to earn 5, 6, or 7 in long-term in the stock market, I'm going to do the stock market thing. But now if the rate's 2.8 in the risk-free thing, there's going to be less people, not all people, but let's say 10 to 20% of those people who before were putting money in the stock market would now say, you know what, 2.8 is okay. So that's less flow, if you will, into the stock market. And I'm oversimplifying, and I'm sure people could shoot all kinds of holes in what I'm saying, but to me, that's the essence of it. How much risk do I want to take to get what return? And when the risk-free number comes up, that's less people willing to take risk in other places.
Yeah. Pretty much, yeah.
Go ahead, Timmy.
Pretty much. Yeah, pretty much. So in our process, when Scott usually sits down with the client and they discuss their time horizon, we call it, it is number of years that they want to invest and how long they're going to be investing for. So we also measure the risk throughout this time horizon and how much is that going to affect them. In this case, as Scott mentioned, we look at 10 years for a 10-year investor. And then we say, as he said here, 2.8 if we can get something higher, but the risk has to be a minimum. But if it's anything less than that, then it's not worth investing.
Yeah, I mean, you think back to, Ryan, you're too young, but if you think back to the late 70s and the 80s, a lot of people were earning 8, 9, 10, 12% on munis or CDs or whatever. And they thought, well, why would I risk the stock market? And of course, the 70s were horrible, horrible years for the stock market in terms of growth. Almost no growth outside of dividends in the stock market in the 70s. And the reason for that was people didn't need to take the risk to get a higher return. Now, the fact of the matter is inflation destroyed a lot of the gains they got, but that's another conversation.
So the risk-free line, what I just learned, still risky. And the higher it is, the worse it gets. Am I getting, as far as stocks go?
Yeah, I mean, it tends to diminish the amount of money that's willing to take risk. The higher the risk-free rate of return, again, if you could go down and get 5% on a CD right now, a lot of people would do, especially retired folks would. That's a big complaint, right? Is one of the big complaints is that older folks who thought they could put money in a CD, 100 grand in a CD and make $5,000 a year to live on, couldn't do that. Now they made less than $1,000 or less than $500. So they had to take risk they had no choice, or they would not have had enough income. Now it worked out for them because the markets have done well. But if you say to somebody, well, now you can get 5% and you were trying to get 7 or 8 in the stock market, they might say, you know what, keep that extra 2 or 3%. I'll do this risk-free thing, right? Then I can sleep better at night or whatever. I would argue, and I think we're seeing that played out, the higher the risk-free rate of return, the more inflation plays a role. So your net return, I mean, think about it. If you're getting 3% on a 10-year, but inflation's 7%, you're still getting your behind whooped. So there's more to the conversation than just what is the risk-free rate of return versus the potential return in risk-based assets.
Now, I don't remember where I heard this. It was probably from you because you're the smartest person I literally know. Is that this last market?
You need to meet more people.
I don't hang out with a lot of eloquent people. Let's put it that way. But it was the fact that like this market has been so good recently that you just sort of look like a genius all the time. So a lot of people think they're really good at the stock market just because it's only been going well, and when a hard time hits, they're gonna not really have any idea what to do. Is that valid?
I think that's very valid. I think we're going to see that happen. I think that people will panic. I think people, I hate to say this, but even in my profession, the average financial advisor in my office, outside of myself and my partner, is probably 35 years old. They have never seen a down market in their careers. And I think there's a few of them, if I'm being honest, that believe it's not coming or it's not possible. It is 100% coming. It is when I don't know, but it's 100% possible. So it's only a matter of time, as I've said a million times. Capitalism is the greatest. Free market capitalism, our equity markets are some of the greatest inventions of all time for creating and distributing wealth. That doesn't mean they don't have bad days. And a lot of people struggle with bad days. The people who excel at bad days, who stay the course, who actually get more aggressive, be courageous when others are fearful, and fearful when others are courageous is a saying that Warren Buffett's camp is very fond of. And it remains true. A lot of people your age, my son's age, my advisor's age, have not seen down. Now, they think they're prepared for it. They think they'll be okay when their statement is bleeding red ink all over the place, and they used to have 600 grand and now they got 400 grand or 450. They say they will stay the course. They would say they will stay in, but half of those people are lying to themselves. And that's where we come in to build a portfolio, to have discussions, to sit them on the couch, to smack them upside the head, whatever it takes. Go Will Smith on them, whatever it takes. To keep them in their seats, because that's where people make the biggest mistakes.
Now, and I just thought about it. So last big real economic downturn was that 2008 crisis, right? It's now 2022. Yeah, I guess there are people that have had whole careers and very successful careers that have never seen a bad time. But again, you talk about that it's going to 100% happen, but there's got to be hope as well. It's that 100% going to come back, right? That's the hope.
It's not just the hope, it's the reality. Because if it doesn't, we've got a whole nother set of problems, right? If you say, again, I've had this conversation now on the air many times, but I'll say it again. If you think Microsoft, Apple, Exxon, Chevron, Procter & Gamble, Coke, Pepsi, Medtronic, Pfizer, you think all these companies are going to go down and never come back up again, well, then it's Armageddon, right? It doesn't exist. The markets do grow, productivity does improve for companies. If it doesn't, they get kicked out of the game. It's creative destruction comes into play, where we get rid of companies who don't do well and grow companies that do well. And if none of the companies do well and they all go out of business, again, I'll see you in the streets with gunpowder and corn seed.
Well, I also think that's not going to happen. So if you want to see Scott in a hopeful time, that's EdgewaterFamilyWealth.com. And the number again is 407-648-1881. Scott, Tammy, it's always good to spend a Sunday with you, gentlemen. with you, gentlemen.
Yeah, and clearly people are rich, right? Or wealthy. You don't have to be rich. I like the term wealthy better. I mean, to rich reminds me of like the Monopoly guy or something. But, you know, they're people, they're regular people.
Now that guy I trust.
Yeah,
See, the problem, Scott, you don't have a monocle.
Monocle is, now, if you give me a guy with a monocle, I mean, like, I'm all in.
What was his financial advice? He said buy Park Place?
Where is that?
Where is that? I can't find it.
Tune in to It's Only Money with Scott Brown from Edgewater Family Wealth, Sunday mornings at 7 on Real Radio 104.1. Raymond James Financial Services, Inc., member FINRA SIPC. Edgewater Family Wealth is not a broker-dealer, is independent of RJFS.